I think the big surprise, in a good way, was the profitability for the holiday quarter, better margins, leaner inventories. What drove that?
Yeah, in general, it's been a gradual improvement over the past 2 quarters. We had, of course, as we talked about in our last earnings call, driven our inventories down somewhat as we made our demand planning actions coming into COVID. The good news was that what we had was the right stuff, the right place, the right time, and we were able to drive a better full price, and we were also able to activate our new e-commerce platform, the North American e-commerce platform, which, as you mentioned, really helped us do a better direct consumer business in the quarter.
Overall sales, though, were still down. I mentioned accessories as a bright spot. Obviously, mask sales were very hot for you, but overall sales were lower. Patrik, is that a COVID thing with stores closed and traffic down, or is it a brand problem?
It's a combination of stores being constrained, stores being closed in Europe, stores being closed in Canada, and also the inventory availability. Again, at the back half of the year, we came into that fourth quarter and third quarter buying less, so it was also a question of availability. But we did shift a lot of product from Q4 into Q1. 2021 based on COVID impacts, which also played in pretty dramatically into our quarter.
You also gave guidance. I think one question I get when I talk to investors and analysts about this company, and I'm sure you do too, is when do you go from a profitability focus, which you've done and been able to increase margins, into a growth focus and start to really compete on growth levels with, say, some of your competitors, what they're seeing now, Nike and Lululemon?
Well, first of all, we will grow in 2021, and we will become profitable again. I think that's really important. But we want to do that while we constrain demand. We want to make sure that we're selling the right product in the right place to the right consumer, so to speak. And for us, that is incredibly important in the near term. We'll continue to grow. We'll grow in 21, we'll grow in 22, but it's very calculated and prudent growth. We want to make sure that we take out undifferentiated distribution. We've been very clear about the fact that we are going to exit 2,000 to 3,000 doors here in North America over the next 2 years. And we're also going to constrain demand in terms of the inventory that we put into the market to make sure we return to premium, healthy growth.
Shepard Smith here. Thanks for watching CNBC on YouTube.